The latest round of economic data revealed the nation's economy is growing slightly slower than expected. Strong consumer spending and a jump in export revenue drove growth at just 0.5% in the December quarter. That's 2.7% across the year. And at the same time, households are now saving the smallest share of their income since pre-pandemic, since 2017. Let's bring in Cherelle Murphy. She's the chief economist at EY. Cherelle, thanks for your time. I guess first and foremost, the point the national accounts show is that those rate rises are biting now.
They certainly are. Household consumption still did grow in the quarter by 0.3%, but that was a lot softer than the previous 4 quarters. We also saw some evidence that household income, disposable income, is really being affected. So household interest payments rose 23% in the quarter. That's a huge number. At the same time, taxes were also high. They rose by 10%. So when you put those together, it meant that household disposable income actually fell. And of course, that's going to hurt.
It's going to hurt in a big way. And in terms of those bigger numbers, though, the broader numbers, the growth would have been negligible, if anything, without population growth.
That's right. When we look at the GDP per capita numbers, you can see that that only grew by 0.8% over the whole year of 2022, and in the December quarter actually did not grow at all. So in other words, had it not been for new migrants coming into the country, students and holidaymakers helping to boost some of the spending numbers, things would have been even softer.
It's a reminder of how important that migration story is, both in terms of supply of workers, but also in that broader growth outlook.
That's right. And you can actually see that also in the industries that benefited through the quarter. So it was those in accommodation, hotels, cafes and restaurants that did best, as well as the mining sector. That was also strong. But it was a lot of those service industries which do, of course, service those new migrants and people coming into the country for holidays that held up best. So, you can see it right through the national accounts.
So the RBA would be seeing some of what they want to see, some slowing. So where to next for rates?
That's right. They would be happy to see that slowing. But, of course, the Reserve Bank doesn't target consumption or GDP or household incomes. It targets inflation. So what it needs is to see that slowdown in the economy translate to prices, to give them some disinflation, because that's the only thing that will get them back to the 2 to 3% target band. Now, they're not there yet, and I think they're going to keep their sort of foot on the pedal to make sure that the economy does slow enough to give them that disinflation, because in the end, what they need to see is inflation falling, and that still feels like it's some time away.
Is monthly inflation, that number yesterday, which had inflation down at least on a monthly basis, is that not enough?
It's helpful. It certainly was softer than the market expected, which was 8%. It was only 7.4. That's a relatively good number. But when you consider that their target is 2 to 3, we're still a long way from that. And the Reserve Bank is still going to want to make it very clear to households that they're not going to take their foot off the pedal until they see again some more price relief.
A lot of people hurting with interest payments. Up a huge amount, and $20 billion paid just in the last quarter by households in terms of mortgage repayments.
That's right. It's a big number, and what's so extraordinary about it is just that jump, between the September quarter and the December quarter, as those rate hikes that the RBA put in back in May, June, July, August, September started to filter through into the household budget. And of course, when we look at the year ahead, as a lot of households face that so-called mortgage cliff, when their fixed rate becomes variable and takes a big jump up, that number is going to get bigger and bigger as the Reserve Bank puts in more rate hikes. So I think we've got a lot more to see there.
And it does have a lag effect, obviously, those rate hikes, particularly with that scenario you pointed out, a lot of people coming off variable rates. Are we going to hit a recession?
I don't think we'll hit a recession. The Reserve Bank's going to be keeping its eye really closely on the numbers. So as soon as it sort of feels like it's done enough, it will pause. And then, of course, if the economy started to tumble and fall quickly away, then they can reverse what they've done with rate hikes. In other words, they can, start putting cuts back in place. So they'll be really, really sensitive to that. The other thing we have to remember is they've still got a really strong jobs market. Despite the fact the economy is slowing, employers are still looking for staff. The wage bill is still going up. People are still being paid more. And that's really putting a buffer under the economy and hopefully will help us avoid a recession.
It is a precarious time, though, isn't it? Internationally, as well as at home, and obviously what happens in China and that turnaround off the back of zero COVID will have a big say in how our economy and budget prosper this year.
Absolutely. We're so sensitive to that economy. And as we look at the commodity prices coming through, they are very positive. And, you know, there is certainly some upside to the economy from that. We saw yesterday in those national accounts numbers that the export numbers are still really good, terms of trade really high. You know, there's a lot of money coming in from there.